want to make sure that you can get a copy of it afterwards. So once again, thank you everybody for joining us for this really interesting session. And I want to thank you for coming to our ECI webinar series. So for those of you who are familiar with us as real estate developers, this is obviously very much so outside of our wheelhouse. I can tell you, I don't really know much about gold. I don't know much about silver. I don't know much about precious metals generally, which is why we have the expert here today, Rich Checkan, who's going to fill us in with that. I do want to give a little bit of a background with Rich and ASI. Rich's relationship with our company, ECI, has been around for much longer than I've been with the company. I've been with them for about 8 years. But Rich and Mike Cobb, our CEO, have known each other about 2 decades, 2.5 decades at this point, Rich?
That's about right, yeah.
For quite some time. And the first time that I really saw Rich in action, I mean, I've seen him at conferences before. Rich and Michael, they'd be at conferences and we'd get on the side of the booth and talk and catch up about what's going on. But the first time I really saw a transaction happen was, I think, back in 2016. It was, we were at the same conference either in Nashville. We were trying to figure out where it was, either Nashville or LA or Dallas. We don't exactly remember where, but Rich and Michael come up with these stacks of coins and give them over to Mike. And I'm like, what in the world is going on here? And Mike, I didn't know about this before, but he had ordered a handful, I mean, hundreds of pre-1965 quarters. And I actually still have a bit of a stash in my room here, but pre-1965 quarters. And this was our giveaway at the conference. And so when I got to talking to Rich about it, I think they're, what, 90% silver at this point, Rich?
90% silver. So what a lot of people don't realize is you can still today buy a gallon of gas with a quarter, as long as it was 1964 or earlier. It's worth over $3, yeah.
Amazing. So I have a few of them here in my drawers. And what I'll do next time we're allowed to go out to conferences, I know it's a bit of a weird time right now, but I'll bring a handful with me. So if we ever connect at conferences, folks who are on the line, we'll make sure that I have an extra one for you to give. But that was just the first time that I saw this transaction happen. And I thought it was just so neat to see that there really is still value to gold and silver. And obviously there is. That's why we've invited Rich here today. But Rich, why don't you tell us a little bit more about ASI, and then from there we can jumpstart into the presentation.
Sure, sounds good. We've got a lot to cover in the next 3 hours. No, okay, so we're not going to talk for 3 hours. That might be a bit much for me too.
I think between the two of us, that's very much so possible.
We could. We will not, though. Just don't worry tonight. But yeah, so asset strategies, I've actually got a slide. Can I go ahead and start moving forward?
You should be able to control it there. If not, then just give me a shout and I'll help you out there.
All right, first of all, just the title, especially if you've seen what's gone on in the markets today, you're probably sitting there scratching your head thinking, you know, fear of missing out. I've missed my chance. Gold and silver are gone to the moon and I missed the flight. Nothing, in my opinion, could be further from the truth. So we're going to talk about that here today. And if I can get the controls again. There we go. So Asset Strategies, we were founded in '82, so we're a 38-year-old company founded by my uncle Michael and his partner Glenn. We basically primarily deal with tangible assets, so precious metals and rare U.S. gold and silver, and some world and ancient coins. We've had a lot of innovations over the years to include working with the 90% junk silver that Rachel held up at the beginning, making precious metals available in IRAs since '86, the Perth Mint Certificate Program and the Perth Mint Online Depository Program. These are the only two government guaranteed precious metals storage programs in the world. We help develop them. So we've had a lot of impact on the industry, you know, getting platinum and palladium coins available and for investors, because initially it was just industrial metal, and we said there's a market here, let's get them available to investors. And you know, lo and behold, you can see palladium's outperforming everything in the complex right now. And you know, the important thing to know about us is I don't want a trade. Okay, so if you're going to know anything about our company, you're going to know that it's all about customer service. My people are not paid commission. They are there to help you meet your goals. If they do that, we'll take care of them. Okay, so nobody's going to sell you something just because they make more money. They can only work with you and maybe talk you out of a trade if it's not good for you, because they're there to help you meet your goals and objectives. So that's the important thing to know about us. It's not just lip service. I want to go back to August of 2018, and I'm hoping we'll get on a little bit sooner next time, but it's been about 2 years since we've been on the webinar here with ECI. And back then, this was my kind of preview slide. I said we were going to talk about current sentiment at the time, the economic landscape at the time. We were going to talk about the fact that we thought change was coming. This is 2 years ago in the metals market. We were going to make the case for gold, and we were going to give you some ideas on how to grasp that opportunity. So that was basically the menu for the webinar 2 years ago. And controls again, do they keep giving away or? Okay, so back then we talked a little bit about sentiment for precious metals being at a 30-year low. And I remember having this conversation. So 30 years ago, basically is right about the time or shortly thereafter I came to work for ASI. And I can tell you when I came in, I thought, oh my God, what did I do? I have walked into an industry that is dead or dying rapidly. I had people calling me up saying that gold at $250 an ounce was way overpriced. It's a barbarous relic. It was never going to be needed in this world. And there were other better products out there. And I thought, okay, so my job in joining ASI at that point, I thought was to help carry the casket to the grave. Nothing could have been further from the truth. Back at that time, or back in August 2018, when the sentiment was that low, I had folks that we do business with at various mints, wholesalers, retailers. One mint director actually told me that they thought that since business was so slow on their production floor at the mint, and this is a government mint, they said since it was so slow, they thought if you just added flowers, you couldn't tell the difference between that and a funeral home. All right, that's how bad things were. And, you know, the bottom line is money goes where it's treated best. And if you recall from the 2008-2009 financial crisis to that point, it was all about the stock market. You know, we were making new highs, seems like daily, and it was nothing but up, up and away. And that's where money was going. And honestly, that's where money should have been going, because that's where people were turning it into more money or more wealth. So I talked a little bit about the state of the economy back then. You know, unemployment figures were very, very low, although I had my doubts about them. They're currently not low any longer. We'll get into that. But, you know, back then the unemployment figures were very low. I think part of it was people were dropping off the rolls and being no longer being reported. I think people that had a high paying job and had gotten kicked out of the workforce in 2008, 2009, rejoined the workforce. Therefore, they're counted and the unemployment numbers came down. But maybe they were working a part-time job. Maybe they were making much less than they were prior. So I think a lot of that was going on and it didn't reflect the current situation. We hadn't really, at that point, seen inflation kick in from all the incentive and the stimulus in 2008, 2009, and a lot of people were scratching their heads wondering where it was. Well, I think we know where it was. It was in the stock market. It was in inflated values and stock prices. So I think that's where the inflation really took hold from the 08, 09 stimulus. Consumer confidence was still very strong at that time, but even back then, 2 years ago, we were starting to see some serious signs of social unrest. And, you know, the way I look at it, there's only one reason you're going to have social unrest. It usually follows financial crisis or financial unrest. Okay, so that tends not to go away until the financial problems are solved. So that was the situation back in August 2018. And my message was, and most people thought I should have been committed at the time, was change is coming in the metals market. Watch out. It is time to get into gold. It's time to get into silver. And, you know, I don't know how many of you listened to me back then. Can I see a show of hands? How many were at that webinar? Okay, I can't really see your hands. But the bottom line is if you listen to me then, you're probably very, very happy now, and good for you. If you did not listen to me then, I can tell you in my honest opinion, this ship has not sailed. There's still plenty of opportunity, and part of it is because of this. You know, Ben Bernanke, after the 08-09 collapse, I think it was probably about 2012, he may have made the statement on a FOMC remarks section after an FOMC meeting, Federal Open Market Committee, and he basically said what the Fed was trying to do to get out of the crisis. They said, quote, if people feel that their financial situation is better because their 401k looks better, or for whatever reason, their house is worth more, they're more willing to go out and spend. That's going to provide the demand that firms need in order to be willing to hire and invest. All right, this is smoke and mirrors. This is a house of cards. They don't need you to be financially better off. They just want you to feel financially better off so you can spend and spend the economy out of crisis. That was the plan, and I think they worked it to perfection. So let's take a look and see what's happened since then. I don't know if you can see my mouse, but if you take a look right around 2018, shortly after this webinar, basically in the fall of 2018, we saw the first rise in gold. Then it retraced a little, as it tends to do. I like things that move in a stair step and not in a straight line up or down. And then you see what happened in May of 2019. So a lot of people look at this last lineup that we're experiencing right now and they say, okay, gold is rising because of the pandemic. It's all triggered by COVID-19. I could tell you that could not be further from the truth. The breakout in gold occurred in May 2019. At that point, we had been struggling for about 2 years or more to overcome technical resistance on the upside at $1,500 an ounce gold. I'm sorry, correction, $1,300 an ounce gold. The reason that resistance was so strong was because when gold fell back in 2013, if you'll see here, it came to rest at $1,300 gold. So from the all-time highs near $1,900 an ounce all the way down to $1,300, there was nothing stopping it. It was like a hot knife through butter, and then it consolidated there. And it consolidated for about a year or two. And that strong consolidation on the downside before it fell further, it eventually got all the way down to $1,050 an ounce in December of 2015. When it got down that low, it consolidated, but we had to overcome that resistance. Consolidation on the downside or support on the downside becomes resistance when we move back up through it. And that was formidable. It took 2 to 3 years for us to test, get through, fall back, test, get through, fall back, that $1,300 level. Once it finally built up enough strength to get through it, it took off and didn't look back again. Okay, so we saw that rise in May of 2019. It pulled back a little and then started moving back up in the fall. And then this last little spike here at the end is where the COVID news came out. And not so much the COVID news, but the governments worldwide and their reaction to COVID-19. When they shut down global economy and said, everybody just hide in place, okay? That is what really gave the final impetus for gold to take off. So people look at the movement over the past year. Gold should not be going from a breakout to all-time highs in 1 year. I think that is COVID, okay? It was on fire, and then COVID was the kerosene thrown onto that fire, which lit it a little further. But by no means do I think that that means we're at an end. I think we're just getting started, and I'll tell you why. Looking at silver, a little bit different story. Now, I don't know if everybody knows how silver works in the precious metals complex, but it's more volatile than gold because it's a smaller capitalized market. Okay, so if you put the same amount of money in the gold markets as you do in the silver market, it'll have a bigger impact in the silver market because it's a smaller market. It's like throwing a pebble into a puddle versus a lake. You're going to have bigger ripples as a percentage of the overall volume in a puddle than you would in a lake. So that's what silver's like to gold. So what we see is gold tends to be more volatile, both to the upside and to the downside. And it follows its leader religiously. It follows gold, okay? So gold will tend to make the move first, either up or down in a market. And then once gold establishes that trend, silver will follow and eventually outpace it, either to the upside or to the downside. So when gold came down to 1,050 an ounce from 1921-17 back in 2013, silver came from about $50 an ounce all the way down to 1383 in December 2015. Much greater percentage fall. But prior, in the 01 to 2011 bull market, 10 years, gold actually went up about 650%. Not too shabby. On average, a 65% return for 10 years running. Silver went up 1,000% in the same period. So we tend to see that. The same thing happened in 71 to 80, the previous bull market. So silver follows, eventually catches up with and outpaces gold both to the up and down side. So when we look at these two metals, it's not surprising that silver lagged after initially running with gold in the breakout in 2019. It went backwards, it receded, and now it's on a tear. It has made up the ground. I think the numbers so far for this year, since January of 2020, gold is up about 32%, silver's up 42%, and I calculated those numbers before today's 7% move in silver. So silver is on fire right now. It is catching up and soon will surpass gold, and I expect it will keep going and running for some time. So as I mentioned, we had an accelerated bull market. So the breakout was in May 2019. That's when it all got going. The pandemic added fuel to the fire and silver started catching up. Well, let's take a look at something that kind of shows this. This is a 20-year gold to silver ratio, the GSR. And this is a number that we all kind of watch in the metals industry. It's the number of ounces of silver it takes to buy 1 ounce of gold. So if it's 1-to-1, then silver and gold are the same price, but that's not the case. Gold is much more rare than silver, carries a much higher price. Typically, when gold and silver trade somewhere around 35 to 50 ounces of silver for 1 ounce of gold, that signals the peak of a bull market. When it takes 80 or more ounces of silver to buy an ounce of gold, that tends to show the depths of the bull market. So what happens at that 80 mark typically is gold and silver both start moving up from the lows, but silver will eventually outpace it and bring that ratio down to 35 to 50. So there's kind of 3 things you want to do there. If you hit that peak, and you see 3 peaks or 4 almost peaks, but really 3 peaks in this chart, what happened at those levels at about 80, that's when it signaled the bottom, and gold and silver both started moving up. So it signals that your gold cost, therefore your insurance premium for your wealth insurance is cheap. Great time to buy gold. If you are interested in profit, here I'd be looking at silver. Remember, it goes further to the downside and higher to the upside. From down to up, it's a wider pendulum swing and a greater profit potential. Okay, so there I look to buy silver at the 80 mark if I'm interested in profit. If I'm a trader, what I do at 80 is I sell my gold, I buy silver with the proceeds, and when it falls down from 35 to 50 to 1, then I'm selling my silver and buying gold and trading the cycle back up. So that's kind of 3 ways to progress depending on what your motivation is for owning precious metals. I could tell you that we hit 80 for the first time in August of 2015. We hit 80 for the second time in March of 2016, and right smack dab in the middle, December 2015 was the low point for both metals in price. So the numbers worked. The problem is that it didn't reverse. It continued to trade an extended time period at that 80 level, inching up, dropping back, inching up until this spring, where it went ballistic, and the gold silver ratio hit an unprecedented level of 127, 128 to 1. At that point, if you get our newsletter, you know we were screaming to buy gold and silver, that something had to change here. So that's that spike you see there. And in that short period of time over the past couple months, that figure is down today to about 77, 78. It has corrected significantly at this point. Are we there yet? So we've seen gold hit new all-time highs. Silver has caught on fire. The gold-silver ratio is coming back down, albeit it just barely got below 80 again. You know, are we there yet? Gold's there. What's next? What else is there to do? How high can this go? I can tell you, I just wrote an article for Thursday's August edition of our newsletter information line, talking about a market update and, you know, where I think this can go. And I can tell you from experience, historically, gold and precious metals bull markets tend to be long and significant. Okay, so if you look at the previous two, 1971 to 1980, about 9 years. Okay, you look at 2001, 2011, 10 years of a bull market. So we're looking typically about a decade of run for a precious metals bull market. You can't really look prior to 71, and many of you may know this, but in 1971, Nixon closed the gold window. Basically what he did is he said dollar bills were no longer convertible for gold and vice versa. So they've separated at this point, and gold traded freely. And that started gold's rise from, just a handful of dollars, under $100 an ounce, all the way up to $8.50 an ounce in January 1980. So that really kicked off the first bull market in a free-floating gold economy. The second one was 2001 to 2011, and the third one started last year in May. And we'll see how long it goes, but it tells us that it's going to be about a decade long typically. When I say significant, I already gave you some numbers. Gold went up 650% in 10 years. Silver went up 1,000% in 10 years. Same type of numbers, 71 to 80. So that's typically what we see. Now, I don't know with COVID and the economy and the way we dealt with COVID and the economy that will play out to those levels. But every time that we saw a bull market from the peak or from the trough to the peak, you're seeing somewhere around 2 to 3 times the value of the metal when you hit all-time highs. And at the trough this time, it was about $1,050 an ounce. I am thoroughly convinced that before all said and done, we're going to see somewhere between $3,000 and $4,000 gold. Silver, twice now in a bull market, has gotten to 50. There are people that are calling for 100 to 150, $200 silver. You get past 50 and hold it, and then we'll talk. I think 50 is reasonable again for silver. We're already, half of the way there, if you will, or I guess a third of the way there from the depths at 1383. So I don't think we're there yet. The last reason I think that's the case is not just historical length and statistics of performance and appreciation. I think we're not there yet because we're doing stimulus and monetary expansion that is unheard of. This is 2008, 2009 on steroids, okay? Now, everybody knows the kind of stimulus that's being pumped into the economy at the corporate level, at the individual level. We know people have the money. Is that real money or not? I don't know. When you create it out of thin air, no goods or services were created to generate that wealth, and all of a sudden people have it in their pocket to pay their bills. What that means to me is we have more dollar bills in circulation right now that are chasing a finite number of goods and services. The only thing that I think can happen in the end is the prices of those finite numbers of goods and services will inflate. Okay, a lot of people are wondering why that's not happening already. And to me, with the economy shut down, how can it? Right? Initially, because of the shutdowns, we're going to see a deflationary pressure, deflationary environment. We have inventory backed up. People can't sell it. Nobody wants to buy it, even if it could be sold. And there's no velocity on money. Eventually, I think we're going to move as we get out of the lockdown into a recessionary phase. And then I see inflation creep in, and I foresee stagflation like we saw in the 70s. And we know how that turned out for gold and silver. It was the first bull market. So I think this can go considerably high. I don't expect it to happen all this year, although, you know, given what I've seen this past year, I won't rule anything out. But I do think it's going to take the course of about 9 years for us to go through that process and realize the inflationary pressures. Actions to take. Again, if you've already gotten into gold and silver, wonderful for you. You're already seeing the gains that you probably shouldn't have expected for about 3-4 years at this point. Good for you. I don't think the ship has sailed. I don't think that rocket's hit the moon by any stretch. I encourage y'all to reach out to us, discuss your goals with us, establish a plan, and virtually, in my opinion, in a rising bull market, every dip is a buying opportunity. It's an opportunity to pick up some metal cheaper than it ought to be. So I encourage you to do that. We've got a number of products. I will tell you out there, you can shop online. You can buy proxies in the stock market to gold ownership, although you own no gold. You can own mining stocks and things of this nature. They don't give you any gold. They give you exposure in the market. They don't give you any gold. I think the best way to do it is to actually buy gold. There's a lot of ways to do that, whether it be with personal funds or IRA funds. You can have it delivered to your doorstep. You could have it stored domestically. You could have it stored at accredited vaults worldwide. You can have government guaranteed programs with the Perth Mint. You can even hold some gold in Switzerland, I understand, Rachel, and be able to take loans against it through Key International Bank. But you may talk about that in a little bit. There's a lot of different ways to own gold, okay? And, you know, the best way to find out what's best for you is to call us up, honestly share with us what your goals and objectives are, and let us guide you to a few different options, and then you make your decision as to what's more comfortable for you. But we know the options that are out there. Don't just poke and hope and guess. Go to the experts, go to the specialists, and find out what truly meets your needs. Our contact number is up on the screen at this time. You can reach us through ASI at ECI Development. You can clearly call us. We have a toll-free number. It's 800-831-0007. So that's 000710, better than James Bond. But by all means, just pop us a quick email. We'll get in touch with you. I've got a wonderful sales force that's going to reach out and, again, listen to you first, find out what your goals and objectives are, and help you meet them. And if you go ahead and you take that step and you buy some precious metals like we know you should at this point, we're actually going to incentivize that. So everybody who calls us up and makes a qualifying purchase of gold or silver, we're going to give you a free 1-ounce silver eagle. Just mention that you heard of us on the ECI development webinar. The other thing we're going to do for you is just to keep you in the loop and information-wise is we have some really strong email, newsletter, and alert services. So information line, I mentioned, I just wrote an article that goes out the first Thursday roughly of every month, 4 or 5 articles covering precious metals and the macro dynamics. And then every Tuesday and Thursday, we send out always something interesting, ASI email alerts, just one article. It could be a promotion. It could be some informational pieces, typically on Thursday, but they're free, and we'll send them to you so you can keep abreast of what's going on. By all means, if you start getting them and you say, this is not for me, and I don't think you're going to say that, then just tell us and you can unsubscribe easily. A lot of people have gotten them over the years, and we've been doing this for 38 years. They tell us it's free and it's worth every single penny you pay for it. So with that, I'll hand it back over to Rachel.
Fantastic. Sorry, I think I accidentally changed the screen a time or two in the presentation while trying to get to the header there. But that was awesome, Rich. And I think you really made the case for gold and precious metals. You're right, it was 2018 from the last time that we did a webinar together. And I think a lot has changed over the past couple of years. And if you know, not now, then when? There's really no better question or answer to that. No better answer to that question.
Rachel, this is the best way I know to keep what's yours. So
it's true. And, you know, a lot of people look at it just at the insurance, from the insurance perspective. And, you know, while if you're looking at it from an investment perspective, that's a little bit different, but looking at it from the insurance perspective, I think is a really, really smart way of analyzing precious metals and gold and silver and seeing how it best works for you. And you touched upon this a little bit before as well, Rich, but gold line of credit. So when you decide that gold is right for you, you are able to take a line of credit against your gold. So you never actually have to sell it. We work directly with Key International Bank. I think a lot of you have heard about them at this point, but they are located in Belize. It's an international bank. So there you purchase it through ASI, and then from there you're able to store it in Switzerland, apply for your gold line of credit, and then once accepted, you can get up to 75% of your gold value in a loan. So it's lower interest rates actually than we typically have at 5.9%. KeyBank usually charges anywhere between 10 to 12% interest, so that's a phenomenal rate there. If you'd like more information, do let us know, but talk to Rich first about getting your gold in order, and then from there we can certainly have that discussion about what the next step is to use that gold. I think that's great. That way you never actually have to sell it. You continue to hold on to it, and you just have that line of credit against your gold as collateral. So really, really strong opportunity there. And then of course we did want to mention a couple of opportunities. We are obviously very, very much big believers and firm believers in hard assets. As a development company, our company's portfolio really is built around hard assets. And for those of you who aren't aware at this point, we have the Best Western condos and suites in Belize. So this is a property that we recently branded as a Best Western. Studios there under $99,000. And there's one remaining. It's a pre-construction building. We actually started construction this month, just a few days ago. It'll be about 10 to 12 month build period, just in time for the tourism market to restart there in Belize. But I would recommend taking a look at that if you're looking for ownership of real estate there in Belize. And this is something that you can use that gold line of credit for, is owning a piece of property in Belize, in Paradise. In addition to that, and we haven't launched this yet, we're going to be doing our official launch next Tuesday on a webinar at 5 p.m., but we're going to be launching Pacific Beach tiny homes at our Grand Pacifica property. They are eco-friendly homes. It is totally off the grid, and they are really neatly designed. Again, under $100,000. There's an example of one. We have a few different models there that we are going to present next week. But again, use that gold line of credit. And then also teak. This is something that our development company is a big believer in, is generational wealth stewardship. And teak is often referred to as the gold of timber because it really does have incredible worth, incredible value. And as the trees are growing, they're just literally growing in value. So we have different opportunities there, starting at $68.80 and then working their way up, just depending on the price of the teak, and then what a lot of, or the age of the teak rather, and then what a lot of folks have done is paired that up with a residency package in either Nicaragua or Panama, depending on where best fits your investment and residency goals. So that's just a quick overview of what's going on in ECI. Some of these are new opportunities for our ECI listeners who've been on webinars with us before, but just a quick recap of some of the more popular opportunities within the development company. So with that, we're going to open the floor to questions. I did start to see a couple of questions come through here. So what I'll do, Rich, is I'll just read those out loud for you.
Okay.
I'm guessing that you're probably going to know the answer to a lot of these, and I actually did make a note of the other questions that we had come in through the internet. If you don't know them, then we'll get the answer for you. And
you know me, Rachel. If I don't know the answer, I'm not going to tap dance. I'll tell you I don't know. We'll get the answer for you.
So I think you'll be able to conquer them. But all right, the first one is from JD Pacific, and he says, if we use your private vault, what is the selling commission for exit strategy?
Okay, so ASI does not have a private vault. We work with several private vaults all around the globe, domestically and offshore. I will tell you, in most cases, you're probably going to see for gold somewhere around 0.5 to 0.75% storage fees. And for silver, it's probably up about 1.5, I'm guessing 1 to 1.5 for storage while you're there, with the exception of Perth Mint, which has options for no storage fees, but we can cover all that ground when we talk about what your goals and objectives are. Depending on what you buy will dictate your entrance and your exit premiums, okay? So if you're buying a Gold Eagle, you're going to have a different entry premium than if you bought a 1 ounce Pamp bar, for instance. And the same thing on the exit price. So that's really going to be dictated. The type of material you buy and sell, the quantity you buy and sell in will have an impact on the entrance and exit commission. But our job is to help you by the lowest means that gets you to accomplish your goal, and we'll do that.
Perfect. So next one here is from Wayne, and he says, so with gold at $2,020 and silver at $2,611, in your opinion, which would be a better buy right now?
Can we do a two-way dialogue? What's your objective? Are you looking to buy wealth insurance? Are you looking to buy for profit? And the reason I ask that is everybody I ask in like 26 years of doing this tells me, nope, I'm buying it for wealth insurance. That's why I'm doing it. I want to make sure that I have some hedge against dollar and dollar related assets. The reality, what I found out in 26 years before and after, is everybody wants protection, but everybody also wants profit. And what you have to figure out is what is more important to you. And what I would probably suggest is a combination of the two, weighted to whichever is more important. If it's all about profit, probably 80-20 silver to gold. If it's all about wealth insurance, maybe 80-20 gold to silver. But you have to tell me something before I can answer that question.
Well, Wayne did just type in here and he wrote both.
and there you go. And then all you have to do is figure out which is slightly more or less important. If they're both equally important, then 50-50. That's the kind of conversation our reps would have with you.
Fantastic. Oh, this is a nice comment here from Kurt. He mentioned, I just recently worked with ASI after reading a book by Porter Stansberry. They really spent time to listen to my goals and discuss all the product options. Great experience. Oh, thank you, Kurt.
Thank you for sharing that. I know it happens, but it's nice to hear third-party confirmation. So.
Yeah, and you didn't pay him to say this, right?
No, but thank you.
Email or something. Fantastic. Oh, thank you. That was really sweet. All right, here's another comment from another Vince. In your opinion, how does this compare to real estate, as real estate provides income and a hedge against inflation?
Okay, so you may want to jump in on this one too, Rachel, and give your thoughts. I think they'd be worthwhile. You've been doing real estate for some time. But the way I look at it is they're sort of the same, if you will. They are tangible assets, intrinsically valuable. They're not making any more gold. They're not making any more silver. They're not making any more dirt. Okay. So the bottom line is they're all intrinsically valuable and they're all real. Okay. I like gold as liquid. The difference to me is liquidity. I can take gold anywhere and very quickly buy and sell it. I've got to go through some hoops before I can buy and sell real estate. That's really the only difference to me. I could tell you my portfolio has both and it wouldn't be caught dead without both.
Right. And I think, that's a really great way to put it. And the real estate side, it's a place you can go visit too. So you can bring your gold to go to Belize or go to Grand Pacific, wherever it is, and bring your precious metals with you if you choose. Not over $10,000 though, because they say the max is.
Well, you just have to declare it. You can still bring it. And I would tell you, go visit Rachel. Belize is absolutely worth going to visit.
A few years ago. All right. JD said, where is Pacific Beach? I'm guessing that's pertaining to Ava, the tiny homes that we have on the other side. That's at Grand Pacifica, which is in Nicaragua. Grand Pacifica is where we're focusing on for the Ava tiny homes. And then the Best Western is there in Belize. So there's quite a few different opportunities in different countries. That's just two of the many that we have in Central America. And then
can I add something, Rachel, there?
Of course.
One of the reasons we hit it off with Mike 2.5 decades ago is the fact that, a lot of people that are out there selling international real estate, they find one property in one location and they sell it whether it fits your needs or not. And that's one of the things that attracted us to ECI and Mike and Joel and Rachel, is they have options that suit all different lifestyles and all different locales and so forth. So they don't have to fit that square peg in the round hole. So.
It's true. Thank you. And, very similar to ASI, we do like to listen to what it is that you're looking for. We understand not everybody's looking for the Caribbean. Although I like the Caribbean, not everybody's looking for the Caribbean. Not everybody's looking for the Pacific Beach. Not everybody's looking for the tropical highlands or the vineyards. So it really just depends on what your goals are and your motives. And if you want to spend time there, if you're primarily looking for a rental property, if you're looking for a mix of both. And it was funny, Rich, when you were talking about people wanting, gold or precious metals as an insurance in a sense, or as for profit. We get the same thing with real estate too. People are like, all right, I want this beautiful please. But I want to come down. It's going to be a rental property, but I want to come down from November to May. Is my return still going to be 10% or whatever the number is? It's like, well, that's prime season. That's when the majority of the rentals happen. So it's just going back to what your goals are ultimately and what, like you said, is most important to you and what you want to accomplish. So this was a comment from JD. I don't totally understand this. It says 1 kilogram gold. You wanted to expand on that, or do you know, Rich?
What was the question? Something about 1 kilogram gold.
1 kilogram gold or silver. So JD, if you want to expand on that, feel free to just type a little bit more there into the Q&A, and
well,
we'll get
while
that.
He's typing in, this may help. Grams, obviously the metric equivalent of weight, right? So instead of measuring in avec poids ounces, which is what you measure your tomatoes and your lettuce when you go to the grocery store, or troy ounces, which precious metals are measured in, you can also measure them in grams, right? So it takes 31.1 troy ounces, 31.1 grams in a troy ounce. Okay, so you can do the math and figure out how many troy ounces in a kilogram.
He made it even easier. He said it was about the commission question.
Oh. A kilogram is currently about a 60 some odd $1,000 bar. 1,000 grams is about a $60,000 dollar purchase. So for a kilogram, it's going to be much cheaper commission than a 1 ounce eagle.
Perfect. And then Josh here is asking, if we are in it for profit, what is the advantage of physical gold or silver over a gold or silver ETF or stock? That's a great question.
Yeah, it's a great question. A lot of people don't understand it. We should do another webinar just talking about that, okay? Because what a lot of people, just pitch to get back on with you, because I think this is important. A lot of people don't understand. When I first got here 26 years ago, people would, say, yep, I got 10% of my net assets in gold, just like my advisor suggested. I'm like, great, what form of gold do you own? And they said, well, I own Newmont stock and a few others. And I'm like, you don't own any gold, all right? You have shares in a mining company. Since 2003, the exchange traded funds are out there, and most of them have no gold ownership. Okay, people don't understand that. You're not owning gold with GLD or SLV. You're owning shares in a trust whose job it is to mimic the price of gold. So you got to ask yourself, why is this a fund, and why is there a fund manager? There's a fund manager because there's something to manage. Physically, the manager is constrained. So if they have all these people buying and selling, pointing and clicking, buying GLD all day long, and at the end of the day, they have to buy 50 ounces of gold in order to meet the demand, they can't do it. The bullion banks won't sell them less than 100 ounces. Okay, so they have to make a decision based on the market and everything else going on. Do I buy 100 ounces and go long, or do I buy nothing and be short 50 ounces. For silver, 10,000 ounces is the minimum. So if they have to buy 5,000 ounces, they can't. So that's why the SLV price is almost never 10 times the price of silver. The GLD price is almost never 1/10 the price of gold, and you own no gold and you own no silver. If you want to own gold and silver, buy gold and silver.
Right. That makes sense to me. All right, a couple more questions I'm seeing here. One is from Doug. Yes, there's a huge difference between owning for wealth protection ownership versus trading. Hi, Doug S. It's great to see your name pop up. Yes, and that is very, very true. And I'm glad that you were able to touch upon it as well, Rich. Yeah. The next question here is from Rich. Any sales tax if we store metal in a private vault and do not take delivery?
Okay, so it varies depending on your jurisdiction. I'm based in the US, okay? So I will tell you that some states post South Dakota versus Wayfair are mandating that sales tax be collected even if the dealer doesn't have a presence in that state. If they're selling to people in that state, they have to charge the sales tax if they overcome certain, minimum thresholds in terms of business and so forth. So in some cases, depending on your state, you may be charged sales tax. I understand in many cases that is changed, and you have to consult your tax attorney. But no sales tax in many cases is collected if you store outside of that state in an area that doesn't collect sales tax. But the moment you take delivery, I understand, you are responsible for that sales tax. So there's a lot of different nuances. There's more answers to that question than we can probably follow the trees in this environment, but give us a call and we could work with your specific situation and maybe give you an idea what you're up against depending on what you're trying to do. But that's not an easy question to answer depending on where you are and what you're buying and where you're storing and what you eventually do with it. But if you never take delivery, there's a good chance you don't have that sales tax option. If you do sell, there are some cases where the dealer has to report that, and you always have to report that. So we may or may not, depending on what you buy in what quantity or what you sell in what quantity, you always have that responsibility unless you look good in a Dayglow jumpsuit.
All right, fantastic. We just sent that one from JD. Here's another great one from JD. First, I'm going to jump down to Wayne, though, because he messaged a couple times. It looks like the ASI, so ASI at ECIdevelopment.com, he said it was bouncing back. It was just one of the email addresses that it was being forwarded to bounce back, but Rich and I both got a copy of it. So if you are emailing that and you get that bounce back, just know that he and I are both receiving it. It's just that one email that it was forwarded to had a full inbox. So
I'll go back into 2018 and pick that up.
So thank you, Wayne, for letting us know. I do appreciate that. All right, so I'm going to jump back here to the question from JD, and he says, could you repeat that 20-80 ratio for profit/insurance? Okay,
so what I was getting to there is, it really depends on what your goals and objectives are. And I don't know if it's 20-80, it could be 66-33, it could be 75-25. What is most important to you? Most people, and it may not be the case with you, I want profit and that's it. That's 100% silver in my opinion, okay? If your goal is 100% insurance, then it's all gold, okay? If you're a mix, you have to figure out what is most important to you. Is it the wealth insurance aspect? Is it the profit aspect? And if it's one or the other, you weight it accordingly depending on how important that is to you. And everybody, it's different. I could tell you, I was just helping out a relative, and she's a little bit older than I am. And, they're really after it for wealth insurance is what she told me. And she said, I really never want to touch it. I want it to pass on to my kids. So I thought 80 or 75-25 in terms of gold might be a good suggestion for her. My wife and I recently purchased, we're in a different place. I'm a little bit younger, and we went 80-20 silver because I've got plenty of wealth insurance already over the past 26 years. So I'm looking to take advantage of this opportunity because bull markets don't come around that often. This is only the third one of my life. So
here's a great question from Doug. He says, from after a run up for a pullback, and how far for how long?
Nobody knows that answer. And if they say they do, I'd run away, okay, because they're lying to you or they're delusional, okay? I do think that a pullback's in order. I mean, like I said, this run up here recently is, fire with kerosene on it. Anything that moves up, especially if it's a healthy long-term market, is going to correct. Stair steps are much better than straight lines to the moon. So I do expect it to come back. A lot of smart people I know think that we could see a pullback to 1800, but it may also never see that figure again. I say if you see a dip, take advantage of it. You see another one, take advantage of it. Much better, in my opinion, to dollar cost average than to try and market time.
Fantastic. And here's another speculation question, Rich. But Charlie asks, how high do you think gold and silver will go by the end of the current 10-year run-up, assuming that the dollar ends up having a reset according to Jim Rickards or the others saying the dollar will collapse?
Yeah. And, on that reset button, we've had several resets, throughout history with the dollar devaluing. I mean, everybody looks at, when they confiscated gold in 33 and they say, oh, that could happen again. They wanted to take our gold. They only wanted to take your gold because it was tied to the dollar. And once they had it, they can reprice gold and devalue the dollar, which is something they needed to do at the time. So now they're no longer connected. So I really don't see that happening again. But there have been other resets along the way. I think, in the end, coronavirus might be the excuse they were looking for a reset. So I do think that's plausible. I do think our time on Earth as the reserve currency is numbered. I don't think it'll go away. I think maybe the dollar will be part of a basket of other currencies and commodities, and it'll be the predominant member of that basket. But when you're 100% reserve currency and now maybe you're 80% of the basket, that's 20% devaluation. Right. So there's a number of different things that could play out here. I said earlier what I believe. I think gold could go somewhere between 3,000 and 4,000. I think that's reasonable. I think silver's got to get above and hold 50 before I look for anything higher. I think 50 is a reasonable number there as well. But time will tell, and I don't know.
Fantastic. Here's another one that I don't know if you can answer, Rich, or it's better by an accountant, but Chris says, just to clarify, I currently live in Ohio that has sales tax on PMs. If I pay to store it in another place and then have to have it delivered after I retire to another state that has no PM, I guess precious metals sales tax, I would never have to pay sales tax, correct? That might be a Maury question.
I absolutely agree. You got to go to a tax specialist and get that answer. I do not want to guide you down the road of ruin. So, and taxes can take people there. Not even going to venture a guess on that one. But if you reach out to us directly, we may be able to either put you in touch with Maury or someone who does know that answer. So, or can give the best guesstimate. But I'm not qualified for that.
All right, I'm going to ask you a couple of questions that were emailed to us previously. So I have them here on my phone, so I'm going to just read them straight here from my phone. It said, what is the best form to buy physical gold in American Eagles, Maple Leafs Gold, 1 ounce bars, Saints, 63s versus 65s, European such as Crown Vics, Helvetia, I don't know if I pronounced
Helvetia's from Switzerland, yeah.
Thank you. One core question is whether coins that trade in a tandem relationship with gold are better long and short-term way to invest in the metal.
Okay, a lot of stuff going on there. But in terms of what's the best, I'll give you my philosophy on gold for wealth insurance and gold and other precious metals for profit. Okay, my personal opinion, take it or leave it. If it works for you, great. I believe everyone should have about 10% of their net worth, or at least their investable assets in gold. Okay, and that's not gold and silver. That's not this, that, or the other. It is gold. I think the best form of that is a 1 ounce gold coin from a major mint. Eagles or buffaloes from the U.S. Mint, Maple Leafs from Canada, Philharmonics from Australia, Kangaroos from Philharmonics from Austria, Kangaroos from Australia, and Krugerrands from South Africa. So that's the type of stuff I look at, maybe Britannias, etc. Okay, so I want a 1 ounce minted coin from a major mint, and I want to take delivery of that. It's the first gold purchase I'm making. I want them to ship it to my doorstep. Okay. And I want to safeguard it and store it myself because I want to have it available to meet a financial crisis if I have one. So my definition of wealth insurance is a store of purchasing power, i.e. gold, not dollars, in a very liquid form, 1 ounce gold coin from a major mint, for a potential financial crisis I hope I never have. And the way I treat that in my portfolio is I buy it, I maintain that allocation, and I never ever sell it unless I have a financial crisis. If I do not hesitate. I sell it immediately, meet the crisis, and then as quick as I can, I rebuild my wealth insurance over time. If I never have a financial crisis, I pass it on to my kids. I give them a start in life. Okay, that's the way I treat that. That's 10% to me all the time, no question. Certain times, like at the beginning of a bull market that's about a year deep, I think you have the ability to profit too. Okay, and there I like an additional allocation of either 10 to 15% of gold and silver. Since this is profit oriented, I weight this personally towards silver. Okay, I treat this differently. Okay, when I buy this, I maintain the allocation. If gold and silver move up, when I rebalance my portfolio, I adjust. So if it doubles in price, I sell half of it. Okay, so I treat those differently, but I like to start out with the 1 ounce gold coins. I don't like to keep any more than I think I need for a short-term financial crisis, or that I feel comfortable safeguarding and storing myself. Everything else I start pushing out in the hands of the professionals, whether it be domestically or abroad. These are vaults, and we have a whole list of vaults that do business properly, as does the one that Key works with in Switzerland. I don't know if that answered your question.
That sounded pretty good to me. And then so the other question, and you just touched upon it, is what should we expect? I'm going to just read the question. What do we expect? Do we expect, and should we wait for a correction? And we talked about that a little bit before. If there's any other last comments you have on that, Rich, feel free to add those in, but you went at great length to explain that.
The only thing I would add is if you have nothing right now in terms of precious metals, go ahead and buy some. Stick your foot in the water. Okay, here. This is fine. And then look for dips. If you already have some, look for the dips.
Fantastic. Well, I think this was a great session. We're right here at the top of the hour. I want to thank you, Rich, for joining us. I want to thank everybody who was online with us tonight. Like I said, I know this is something that's a little different from our traditional real estate webinars, but I think especially all of you who are on the line, you're looking at hard assets in one form or another, and it's wise of you to be looking at precious metals, gold, silver, especially with a lot of the uncertainty that's going on in the world today. So we appreciate you for joining. Rich, thank you so much for joining. It's always a pleasure to see you, to be on sessions with you. We have a lot of fun together, and I'm looking forward to seeing you at some point at a conference, whenever that may be.
When our nanny lets us, right?
Right.
It's my pleasure. I always love it. I'd love to come back as often as you'll have me. So.
Awesome. Well, thank you so much, everybody. Thank you again for joining. Have a really great rest of your day or evening, whatever time of day it is for you. And we look forward to hearing from you. Bye-bye.
Stay safe.